Good evening, everyone. Thank you for joining us on this webinar to discuss a fairly important development in the journey of the tax story surrounding the VC&P sector. I'm joined by a very illustrious panel. I don't think I can do justice by reading out the biodata, but suffice to say, between them, they represent the length, breadth, and depth of the sector, and also a leading Supreme Court lawyer. So just to formally welcome everyone, we have Amritha Salian, the legal head at Chiratae Ventures. We have Ashish Fafadia, partner at Blume Ventures. Dipanjan Basu, partner at Fireside Ventures. Siddarth, partner at 314 Capital, and Sujit, Ghosh, a senior advocate at the Supreme Court. I also have my colleagues, Rahul, Pansari, and Aditi, Samant, joining me. So with that, I'm just going to request Aditi to spend a few minutes just for the benefit of the audience and to set the context, just lay out the working of a typical fund, at least in the Indian context, and why what we're going to be discussing for the next 60 minutes is so important.
Thanks, Abhishek. So, alternative investment funds or AIFs are investment pooling vehicles whose typical target investors are HNIs and institutions. Funds are largely structured as determinate trusts with a few handful operating as companies or LLPs. A fund also requires an investment manager to take the administrative and investment decisions and a sponsor to invest in the fund of what is known as skin in the game. Now, once monies are pooled in and invested by the funds and distributions start trickling in, the IRR for investors is computed, where the return to investors is beyond the promised IRR, also known as hurdle. Under the fund distribution waterfall, a distribution is also made on units which are colloquially known as carried units. These units are generally held by the investment manager or sponsor. Now, it has been a matter of debate whether such return allocation is to be viewed as an investment return on these specially designated units or as a performance fee, which could then be subject to a service tax or GST levy. Now, with this context, I would like to hand it over to Rahul to further elaborate on the stance of the tax authorities on this matter.
Thanks, Aditi. On this arrangement, earlier the tribunal has held in 2021, and they have held that the funds are essentially providing an asset management service to its contributors, and the consideration for this service was held to be the amounts retained by the fund for incurring expenditures, and this will also include the amount of carried interest paid by the fund to the investment manager. Now, the Karnataka High Court has pronounced the much awaited ruling, and they have held the three important principles, which were out of the 8 questions of law framed before the Karnataka High Court at the time of admission of appeal. 3 were found to be relevant and answered by the High Court. Number 1 was the venture capital fund, which are set up as trust. They cannot be said to be a juridical person liable to pay service tax. Essentially, that was due to the reason that in the service tax law for the period under dispute, which was 2005 to 2012, did not contain the definition of person. And this definition cannot be borrowed from any other statute. The second crucial principle, the High Court held that the fund is just a pass-through, as it does not retain any income or profit. So there cannot be a levy of service tax in the hands of fund. Thirdly, the High Court has upheld the principle of mutuality and held that the investor and the contributors, and rather the fund, cannot be considered to be two distinct persons, because there cannot be a service to oneself. It has to be two different persons to execute a supply or of service transaction. And hence, since there is no distinct supply, hence there should not be any service tax applicability in the hands of fund for doing a pooling vehicle contribution in the hands of contributors. So in short, the ruling has answered 3 questions and said the fund is not a person, fund is just a pass-through, and it cannot provide services to oneself. With this, over to you, Abhishek.
Sure. No, thanks, Rahul, and thanks, Aditi, for setting the context. And I think as we were discussing earlier between all of us, the panelists, I just want to also make it clear that while the question on the taxability of the additional return on the carry units was also something that the CESTAT had ruled on, the High Court has not specifically ruled on that matter because the counsel for the party did not request for a ruling on that. Just as a matter of information, a similar case is already pending in the case of ICICI itself at the SESTAT. So to that extent, the final verdict on the treatment of tax, whether it is service tax or GST on carry, is not fully determinate. But with that, let me just open it up to the panelists, and we'll just go in order of how everyone's appearing on my screen. So maybe Dipanjan, if I can just start with you to just share your sort of opening comments and preliminary thoughts on what and how important this ruling is.
Yeah. No, I think it's an important question for the ecosystem. All of us here on the call, or even otherwise, when we talk to investors, LPs, I think there's uncertainty about how this particular thing would be treated. Why carried interest is an important part of the whole venture ecosystem globally. So we are trying to avoid even the word carried interest, right? We try to use different words like additional return and and so on, so which itself is not a very healthy thing, because it's only, we can't, the spirit of the law and the intent of the law and has to be very, very clear. I think the ICICI ruling to that extent, the case was very disturbing in general, not only for all of us as GPs, but in general for LPs as well, because that raises question mark on what more cost can be loaded and what else we are not able to see, and so on and so forth. So from that standpoint, as Rahul mentioned, and as we are interpreting this particular thing, I don't think it solves to a large extent everything that the question is, but maybe it's a baby step towards hopefully solving the larger question. And there are potentially two outcomes from here: that we preempt, based on this ruling, the larger question, saying what happens when LLP does it. Today, it's also a trust which is being treated as not somebody who can provide a service. But when LLP provides the service, then it's not the same entity, right? So will the similar ruling be applicable to an LLP, to a trust? And and therefore what happens to the sponsor entity when the sponsor entity is getting the carried interest? So that remains ambiguous. So I would say a very important ruling from that standpoint, a baby step, but certainly not to the extent that the ecosystem needs clarity on.
Sure. Sujit, would love to hear your views.
I think as a lawyer, I'll say that this is a welcome development, because from a -10, you are now +10, in the sense that you have something to flash before the tax office. But I don't think we as an ecosystem, we need to be very euphoric about it. There are chinks in armor, more particularly because this ruling is restricted to 2012. And therefore, in 2012, the service tax law went through a lot of change. In fact, one of the things that got plugged was the definition of person itself. 2012, they brought out the definition of person to include juridical person. So that argument that unless there is a reference to definition of person on the Finance Act, you can't borrow from other legislation has been taken care of. So that's one aspect of that. But then the mutuality concept continues to operate. But overall, that is not where the game ends, because 2017 we have the GST, and the GST is completely different animal. So I think as an opening remark, I'll say it's a point to be happy about, but not necessarily to throw all cautions onto the wind. We have to be mindful of the various issues that are still yet to be resolved.
Siddarth, I know in your role at IVC and beyond, you've been tracking this matter very closely. So would love to get your sort of opening thoughts on this.
No, sure, happy to. I think see, it's a step in the positive direction, but I think there's a lot more that needs to be done from the legislation as opposed to the judiciary on this. Unfortunately, we've seen when the GST regime came about now, regulated financial services, particularly when it comes to pooling vehicles, etc., did not actually see the pride of place and the clarity that the entire industry needs as of now. And we haven't actually seen much work actually, even though a lot of work has happened in the background, we haven't seen the GST Council, etc., actually pick up these particular issues because they were actually sub judice as of now. Now, it is possible to end up actually relying on some of these judgments in certain elements. But I think what the industry has been asking for a substantial period of time is the fact that we actually need regulatory clarity to end up actually coming here. These sort of structures need to be actually looked at from the perspective of substance. These are all carried interest, for that matter, emanates from the sale of securities. The sale of securities does not actually come under GST or service tax on the same, yet there is a sort of purported fiction by the tax department to say that this particular additional return, as Dipanjan actually mentioned, emanates from services that have been rendered. For any services rendered by the manager, even SEBI clearly mandates that you need to end up actually listing out those fees in details, how it's going to be paid, whether the fund pays it, the manager pays it, etc. When it comes to the distribution waterfall and the distribution of proceeds from investments, the source of that particular income is entirely different. Now, even though we've been saying that for a substantial period of time, we have gone to the department, we've actually written manuals, we've held health classes, we've actually held seminars, etc. This sort of clarity needs to end up actually coming. And mind you, investors across the world are extremely jittery when they end up hearing the words India and tax in their mind, especially when something actually goes to litigation. Speak to any of the managers who are on this call as well, it becomes a massive point of friction. We need to end up getting numerous advisors. We end up actually nitpicking language, creating structures and the like. It detracts from what's actually needed. So clarity is of the essence. It's a step forward in the right direction. But I think as an industry, we shouldn't actually rest on these laurels. The press has unfortunately ended up actually giving an extremely optimistic spin that doesn't actually emanate from the ruling that's come about. And any fund manager who relies on the headlines of this is going to end up actually facing numerous issues over time. So as finance professionals, as GPs, as managers, we need to end up actually looking at the fine print. We still have to end up actually working towards it. This will add to the ammo that we have when we end up explaining it, but there's a lot more work that needs to be done as of now. And the industry needs to come together to end up actually seeking that clarity as well.
No, fair points, Siddarth, and I think some optimism is always welcome, but yes, the devil is in the detail. Amritha, I would love to get your sort of opening thoughts, please.
Yeah, sure. From a lawyer's perspective, I think it's a good move. It's a welcome sort of a thing, because confidence in the ecosystem in general is built by how clear your legislations are, also how they can be enforced, right? So, although there's nothing per se wrong with the judgment, I know it doesn't answer the overall question that we are looking for clarity towards, but it did answer all the questions. It did give us a sense of how the judiciary is thinking about some of the questions that were raised. And that I think is a positive thing in general. Yeah, but there's a lot more work that needs to be done towards answering the question as a whole and giving clarity to GPs on how this particular issue will be treated.
Sure. Ashish, would love to hear your opening thoughts, please.
Thanks, Abhishek. So I think broadly, as at least 5 of you have mentioned, I definitely feel that it's a decent starting point. But I do feel that on the back of this as a starting point, we will have to watch out for the legislative actions on the back of which the law will take its course from here on. Because fundamentally, we don't have clarity and visibility as to what happens in the GST regime. And like Sujit was mentioning, forget GST regime, which was more like 2017 and onwards. What happens between 12 and 17 also post the amendments that happened in the service tax laws. So there is definitely that open area where the only reason I'm still saying it's a healthy start and a first step, and literally it is first of the step number 2 to 10 still remain. The first step, which is a welcome one, is that we at least have the other 2 issues, which are in that zone where we can hold a piece of paper during our negotiations and conversations, both with the investors of ours as well as the tax authorities. How far we can stretch that argument, only time will tell. But the fact that it at least moves the system to acknowledge the fact that fund is a pass-through, and the fact that the investor and the fund are not in that sense 2 separate people, allows for a few things to be at least held on to. But like I say, I do worry about how the legislature ropes in and looks at some of these. If they come on to saying that, no, this is something that applies in the judgment, that's fine. We are not retroactively going to change it. But at least from here on, we are providing a clarity that this has to be treated differently. We are back to square one. So we definitely should be smiling, not laughing.
Yeah, well said. To my mind, I think one of the most important aspects also which we should not undermine, and this is actually a high court ruling, right? Yes, it's not a Supreme Court ruling, but equally it is not a tribunal ruling. So I think there is always a lot of weight that a High Court ruling carries. And notwithstanding the change in law and the nuances of 2012 changes and then the whole GST regime, I think certain factual and principal matters in terms of how a fund operates should sort of pervade across different eras. And Dipanjan, maybe if I can therefore come back to you, I know you've been sort of leading a lot of the advocacy with different stakeholders. How much will this ruling really help you to go and thump the table before the regulators and say, listen, even a High Court has now seen merit in how this sector focus functions, and therefore it's time for you all to give us some clarity rather than leave it all to be decided by the judiciary.
Sure, sure. No, and I think I'm sure Siddarth can add more on IVCA's efforts around this with regulators. But to the limited conversations we've been having, in general, trying to get a sense of how to attract more capital from global LPs into India, that to be seen as a view, and we've been mostly getting positive responses, especially the whole IFSC and the Gift City setup, which is a step towards attracting more high quality endowment and global capital into Indian funds. So the direction seems to be the right direction of not creating more confusion, and therefore, unlike what has happened in the gaming case, right, where Supreme Court, I think, came up with a ruling and immediately the the legislation came in and passed a law to make sure that retrospectively things get more complex. I think I really hope that that is not the case here, where legislation comes into and create something which was like, did we really wake up a sleeping sleeping giant? But that's not what we have been getting a sense of. I think the direction is to be more favorable in attracting best good quality capital. The good news, at least in my mind, is that globally, if there are 100 countries in which there are VC funds, 99 countries have a precedence of calling it a carry, and it is part of the capital gain treatment in most countries, right? Specifically US and Europe and Singapore and Mauritius and so on and so forth. So that, plus with this ruling, I think there is a strong case for legislation to come up. And totally agree with Siddarth that the legislation has to pass it, and while we can't go to Supreme Court and High Court every time there is a particular notice and get a favorable ruling around it. So I genuinely hope that this particular ruling by Karnataka High Court is a step towards legislation to pass something maybe in the permanent budget when the new government forms, and clearly lays out the direction for the next 5 years for PEVC ecosystem, especially on around what's happening with the RBI ruling on banks not being able to invest in VC firms. In general, as we stand today, there are more bad news than good news, right? There are more uncertainties around who can invest in AIFs, and this certainly can be a good way for them to come back and say, hey, the objective is not to really choke capital for AIFs. We want to deliver or encourage more AIFs to raise capital, and this is a good anchor for them to go back and pass something more positively than actually trying to keep it unknown. So knowing it one way or the other is certainly important as we go more aggressively to raise capital outside.
So, Siddarth, I'm just going to bring you in. Dipanjan brought out the Gift City aspect, right? And one of the, for want of a better word, the fears I have is when somebody goes and talks to the government and says, please provide clarity. They'll say, yeah, come to Gift City, set up your fund there. Anyway, there's a full exemption, from GST, so this issue sort of becomes moot. Now, while that's fair up to a point, to the extent you're raising only international capital, but we all know we can't pool domestic capital. So is this again going to create a unnecessary arbitrage between somebody in gift versus somebody setting up a AIF outside of the gift, and again the government just using it to fulfill one of its agenda, which is to promote gift at the cost perhaps of regular AIFs?
So I think, from all the interaction we have with government so far, they do view gift and mainland India as two entirely separate entities, and they don't want one to cannibalize the other. In fact, some of the sessions that industries actually had hasn't actually held much water with either IFSCA or the government, purely because they said, look, we don't want to end up actually reducing the scope of domestic pooling of capital by actually end up creating adverse conditions here and end up actually asking people to move to gift. They want gift to end up actually standing out on its own merits itself, for that matter. The India opportunity to end up actually being compelling enough for people to end up actually pooling money over there. But I think so the important point, the gift versus India narrative, mainland India narrative, I don't think will end up actually holding water. Because I think if that's the kind of narrative that's actually going about, global investors are going to look at this and say, look, this is not a permanent solution. It seems that this is like a Hotel California kind of situation, wherein you invite everyone in to come in for the matter, you suddenly change the rules of the game and it's impossible to exit, right? So you can always check in, you can never check out. And investors across the world, ever since what happened in China for that matter, are extremely wary of the fact that if something actually looks far too compelling and there may be some sort of trick like this that ends up actually getting played, they will actually end up turning very, very, very when it comes to that. So this is a point that's actually been driven home very, very strongly for that matter. And even the role of AIFs as well. AIFs have about 9.2 lakh crores of capital commitments that they've actually gathered over the past 12 years. It's grown at a CAGR. It's actually going to CAGR of close to 112% for that matter. That's over $100 billion of capital commitments that have actually come in as of now. And only a small fraction of the capital has actually been invested currently. If these sort of sudden changes end up actually happening, such as the RBI rulings, such as a particular carry part becoming adversarial, then we will actually see a flight of fund managers end up actually leaving the country, and a number of investors who want to tap the India opportunity, which are looking at surrogates across the world to end up tapping that opportunity as opposed to coming to India directly itself. So I think there needs to be a fine balance of nuance between this. The short-term gains they may end up getting by actually taxing carry as of now, whereas against the long-term detrimental effects and the negative drag on the reputation of India in case this sort of rulings actually end up becoming adversarial. The form and substance of carry has actually been across the world stated to be an appropriation of profits arising from the disposal of investments. It is actually sacrosanct over that. The fact that they're trying to actually pervert it and actually change it to this sort of fee for that matter does disservice to the sum and substance of the operation we end up having. Mind you, one of the problems we've actually seen is that, unfortunately, even though SEBI's actually done a fantastic job, IFSC is doing a very good job for that matter, the other government departments don't fully understand what an AIF actually means. In fact, IBCA and we've actually gone and spoken to the Joint Standing Committee on Finance. We've explained our operating model. We've actually helped them with global parallels, given them a lot of information where they are sympathetic to the cause and understand, look, you are actually doing good work in terms of pooling money. India has actually requires capital to come in as of now. And capital is cowardly. Capital is entirely anathemic to uncertainty. And that sort of material uncertainty will end up actually casting a pall on this entire capital formation that's going on as now. So I think this is something that the government and senior bureaucrats end up actually understanding as of now. They told us multiple times, because this matter is sub judice, there's nothing we can end up actually doing. But now that this matter has somewhat actually become judice for that matter, and hopefully we don't actually end up seeing any sort of I would say appeal or something coming that dragging it back under the aegis of the court. We are hopeful and engaging with the government to see whether we can get some level of clarity. Obviously, the elections are going on now, nothing can end up actually materializing. But when whichever government comes into power, whichever administration comes into play, this will be one of the top priorities that the industry is going to bring to them as of now to say, we need this kind of clarity, we need this kind of certainty. Otherwise, this is a once in a lifetime moment for India. Nobody wants to end up inflicting a self-goal as of now to end up actually detracting away from it.
Ashish, if I can just bring you in, I know you all also have sort of both India and gift funds. Just wanted to get your sort of perspective on how do you see that debate playing out, and do you think the government is going to use that against the demand from industry for clarity, saying just come and do it and gift you anyway have an exemption there?
I don't think so, simply because they are not today at least looking at it from a competitive force between one and the other. The mandate is very clear, like Siddarth was mentioning, aggregate and motivate foreign capital to come in and be here, rather than the other way around. More fundamentally, Abhishek, it is only pertinent for me to highlight here that the capital that comes into gift is any which ways going to be from foreign capital, and you are not going to see people going out from here into the gift jurisdiction. And if something like that was even asked for to do so, you're basically saying that don't bother on building from the India capital. And we are going to be hitting ourselves in the foot, and really hard, because then you are saying that whatever wealth creation happens in India from the startup private equity alternative as an asset class will all be accruing to the foreign investors who are pooling through gift. It is very important, and I've said this in the past on public domains, including some pieces I have written, that an ecosystem which is not going to create its own wealth is akin to a business not having its own brands. It's modern day slavery. So you are definitely missing out a big piece by not allowing your ecosystem here by the HNIs, family offices to pool and benefit. The carry issue, which is open, creates that kind of a challenge. And we any which ways have few parallel things running. We have the bank ecosystem and the institutional ecosystem constrained due to the recent changes that RBI brought about. So a culmination of these would lead anybody to ask a question that, let me make it easy. My listed markets are running well, mutual funds are sahi hai. So theek hai, let it be. And I'm not going to really go down the path of AIFs or alternatives, which does not help because all that is primary capital formation. So we are still creating dependencies of a humongous nature on foreign capital and not building our ecosystem on our own.
Well said, Ashish. And I think on the point of international versus domestic, I've also made a lot of controversial statements, and I'll make it again that I don't know why foreign investors get away with a 10% capital gains tax and Indian investors on the same private investment.
The parity in the tax
24.
laws, yeah, agree.
Point. Amritha, just coming to you, I know you represent one of the most storied fund houses. You're always in exit mode, fundraising mode. Always so much action going on at Chiratae. What is your sort of perspective on how this ruling will be looked at in terms of all the conversations you all have with investors, both globally and in India?
Yeah, I mean, see, this discussion has been going on for a while now. I think we've tried to look for clarity. How it will go with LPs is purely, my experience is really, it's a point of leverage that every fund has with probably the LP. It's a function of more that, because either you will agree to pass it on, or the manager entity will bear it, right? It's only one or two ways. So I think it's a good negotiation point for LPs. I've seen both sides pushing aggressively and seeing which, whether you'll be able to push it through to the LP or whether it'll come back on the fund is really, come back on the investment manager is really a function of how strong your track record is, because I've seen cases where LPs are okay with this, okay with bearing the GST finally on carried interest. So I think it's a function of how it's a matter of leverage and a function of how your comfort, your relationship, as well as the fund performance, etc., which will have a bearing ultimately.
Sure. Helpful. Sujit, I'm going to bring you in and maybe we'll take this discussion to a little more technical subject domain. I know this point was brought up multiple times that the law has changed. So maybe ignoring for a moment the service tax changes in 2012, but focusing more on the GST regime, because I think as Ashish made a point earlier in the morning that the growth of this sector in the last few years, perhaps post the GST regime and the kind of multiples that it has generated, are far more dollars than anything that we've seen in the service tax regime, right? So the stakes now are much higher. So just your perspective on everything that you've heard and what you've seen from the SESTAT and High Court ruling, what is your sort of assessment of the current lay of the land from a law perspective under the GST regime? Which aspects are clear,
Sure.
which aspects are unclear, where is the risk,
Sure.
where are the strengths?
Right. No, so let me do a deep dive into the High Court decision itself in terms of what it has held, because that's the foundation. What the High Court has held that, look, trust and the contributors are one and the same, which we call the doctrine of mutuality. It's a pass-through entity and so on and so forth. So basically what they have said is that what applies to clubs, principally, what applies to clubs is what will apply to trusts. Now, if this fundamental, the correctness of this fundamental will be up for challenge. And that is very important for all of us to understand, because while it is true that members who contribute to the trust and the trust are one and the same, but there is an element of profit which was there very copiously discussed in the tribunal decision, which has not been even dealt with by the High Court. And in fact, in the tribunal decision, they go on to deal with various Supreme Court decisions where the profit motive was found to be an aspect contrary to the concept of mutuality of interest. So I think for all of us in this room, we need to be very mindful of testing the mutuality principle per se. That's one. The second point, which is of relevance in the context, is what I see is, the period has to divide into three. So up to 2012 is one era. 12 to 2017 is another era. 2017, when GST came, until about 31st December 2021 is another era. And 1st of January 2022 onwards is the fourth era. And this fourth era, which is going forward era, 1st January 2022, is a very dangerous one. Because that era, the law has been so changed to say that forget about any decision that may have happened from the Supreme Court. It will be deemed to be transaction between two separate persons. So mutuality of interest is of no relevance. If there are transactions of this kind, if there is a transaction or activity of this kind, then they'll be deemed to be two separate persons. In one sense, it gives a clarity. One can say that, okay, now effective 1st January 2022, there is a complete clarity that mutuality does not hold good at all. And therefore, GST must be paid, etc., etc. And therefore, commercials can be drawn up inclusive of taxes, extra, whatever. You can plan your business. That's a good part. But if that's not commercially viable, then we are up against a difficult time. But having said that, I have my serious doubts about this deeming provision that has been brought out. And I think the industry should, if they wish to, they can think of challenging the very concept that they're talking about. What the legislature has done, they have tried to undo a judgment of Supreme Court by just a deeming fiction. Now, whether that is possible, my answer would be, my considered answer would be that is not possible. You have to cure the defect. You have to cure the defect through a legislative means and not just by putting a deeming pressure. It's almost like saying, X was a man, from tomorrow he is deemed to be a woman. That's something that is often, jokingly we call about the British Parliament can do that. But even there is a limitation. So I think this deeming concept, which putting it in a technical form, Section 7(1)AA, which was introduced from 1st of January 2022, is going to be a bottleneck. That's one. Second, I must also tell you that the facts of ICICI, within the facts of ICICI itself, they had two kinds of transactions that they recorded. One was a case where there was no carry given at all. And that is what was argued. And they said that these four funds, there was no carry, etc. Whereas the High Court does not go into any of those. The point I'm trying to make is that different funds will have a different structure. The wordings of the indenture, the wordings of the various other agreements will be different. So let us not assume that what has happened in ICICI's case will automatically apply to every other trust, every other LLP getting into this business. Substantially at a large level may be the same, but the nuances may be different. So therefore, that's the other thing, Abhishek, I wanted to bring about, that in the GST era, more than anything else, because of the fact that they have now come out with a deeming provision, read with the fact that factually transactions could be largely different in terms of the wordings of the instrument concerned. These are the areas that we need to look at.
No, thanks, Sujit. And at the risk of engaging into a debate with you, I would only say that the amendment in 2022, while it in a way disregards the principle of mutuality, also says that then there must be a transaction for consideration. Right? And therefore, in the context of a trust operating as a VC or PE fund, even if we disregard the principle of mutuality, would there not be a strong argument to say that there is no transaction that the fund has with its investors for a consideration, because it is only incurring expenses on behalf of those investors and not performing a service to them for a consideration. The story in a club is different, that as a member you can go in and avail certain services and you pay the club something, and of course what you pay to the club, in a way you're paying yourself, but you're still paying something for a service. I think the argument I would make against that amendment is that there is no service or consideration in the first place, notwithstanding the mutuality principle being now a deemed provision.
No, true, absolutely true. I mean, of course, there is no denying the fact that there has to be a consideration. But again, at the risk of getting into debate mode, argumentative Indians. You see, what happens is, I mean, the fulcrum of what was the case in the tribunal, before the tribunal, and probably that is what was there before the High Court, was that, look, how can I get into a consideration with myself? That's what the argument was, that me, the contributor, and the trust is one and the same, and how can therefore be a consideration? I'm doing it from myself. That was the fulcrum. And therefore, there was no consideration. But the moment you say that you and I are two different parties, okay, in law, then any flow of money susceptible to be treated as a consideration, because the definition of consideration under GST is very wide. It is no longer the Indian contract tax definition that they use. So that's the only sensitivity I'm saying. I'm not saying that it is certainly a supply. I'm not saying that. I'm saying that it gives a handle to the tax authorities from 1st January 2022 to flush the deeming provision, and therefore we need to gear up for that. Whether we challenge it in terms of how can you do that, or we say there is no supply because the fundamentals of a promisor and a promisee is not met at all. There is no promise ever met, and therefore there is no contract of supply in that sense. So that's the point.
I think one part that's also that also needs to come out more rigorously with the authorities is that the trust, or the AIF for that matter, really acts as a extended demat account as well as a glorified bank account on behalf of investors. It merely pools money. The money ends up actually getting invested into various types of securities, investment products, etc. The money comes back in, and then the money is distributed as per a contract that's actually been clearly stated. The rest of the world also, for that matter, the reason why we often use the word LPs and GPs, because the rest of the world actually has limited partnership type structures, which actually end up becoming the basis for these sort of formations. India is also unique in the sense that we end up actually adopting a trust, where India has fairly strict provisions of what a business trust is and how that's taxed and everything for that matter. Decide to actually create the trust for the purpose of investment. And I believe up to 2016, 2017, there was actually ambiguity as to whether this could constitute business and profession, whether it's supposed to be capital gains. We got some level of clarity for unlisted and long-term listed. Short-term listed is still once again in one of those gray areas that are there. But I think the important part that India needs to also end up considering, and the legislature needs to end up considering as of now, is whether these sort of shoehorn structures that have actually, and bandage structure that have held us in relatively good stead so far, can end up actually being the fundamental basis as you become a $5 trillion economy, $10 trillion economy, etc. We need to end up actually moving to global best practices, where across the world, they've actually created very, very clear set regulations and norms. The Indian Trust Act was written in 1882. There's far more case law and precedents that actually exist over there than any of us may possibly end up knowing. Now, the moment you end up trying to explain that to a foreign LP also for that matter, they're just going to get concerned. I think all of us can admit on the fact that when you say that, look, we created as a trust, but you're an LP, in their mind, there's actual dissonance to say, how am I a partner in a trust? Like, what is actually going on there? Why is it a trust? Why are you going down that route? Why are you doing these kind of things, etc.? So I think the other part, as we do all this, the legislature needs to end up actually acting to actually create these sort of pathways. In mind you, the Damodar Committee report from basis news report did actually take it upon the fact that we need this kind of structure to come about. GIFT IFSC actually created a VCC type structure to come in there. IBC has made numerous representations to say we need that kind of limited partnership structure to coming in as of now. We need a separate regime for that particular matter, and that regime has to be reflected in the numerous laws that end up actually applying to the transactions between and amongst GPs, LPs, as well as the entire fund itself. So these sort of piecemeal efforts, the problem is there may be some court in some part of India who may end up having some sort of ruling which ends up actually affecting all the trusts that have actually been created as structures in India as of now. And mind you, even in GIFT, they are actually trusts. So this sort of elements, and if the government ever in the future decides to actually take away the GST concessions given over there as of now, it will actually become a material problem for everyone who is actually involved. So like I said, it's not the question of IFSCA versus mainland India, anything like that. These are common problems that end up actually applying to every sort of fund in the country for that matter. I think the last part is even mutual funds are actually created at these sort of structures. Now, the question is, will something like this end up actually affecting mutual funds? Because as Ashish said, mutual funds sahi hai. For that matter, if this ends up actually killing AIF, to be mutual fund sahi hai, because AIF nahi hai. We can't have that kind of dichotomy end up actually coming into the system. Both of them serve different purposes, different factors of capital formation, and we need clarity.
Absolutely. And Siddarth, on lighter notes, since and Ashish, I know you wanted to add something and we'll bring you in, but on lighter notes, since we talk about jurisdictional precedents, I think it's time more funds come and set up in Bangalore instead of choosing any other city. But with that small cheek comment, Ashish, I know you had a comment on this.
Yeah. No, I just wanted to spend a minute on the point that Sujit referred, and that's about the viability. And while I share my view on that, just a quick one on practicality also. when the income that is so being sought to be taxed, the carry, is not very different from what in a private equity or a VC funded company would be the founder's equity. Effectively, it is not very different from that. And the gains accruing, there are better structures in the under the settlement in the company's law. So we are treating equity with the capital gains. So there has to be acknowledgement by the regulatory frameworks and powers to be that some of these systems are there which are not very well thought through when those respective pieces of legislation were drawn. And maybe there is an attempt that needs to be taken to redraw some of these in the light of what the modern day capital formation structures are going to yield to. In terms of viability, if ever in the future it comes down to the carry being taxed any other way than what it is sought to be today, it not only creates significantly additional tax burdens on the GPs, and I say this GPs knowing fully well that, yeah, you can practically shift it to the LPs as well. But let me not fool myself and everybody else on the group. The LPs are not going to take it kindly. It is going to bring down their return profiles significantly lower if you try and shift the burdens out there on them. We're not yet a proven ecosystem in terms of delivering exits in spades. So given that limitation, you are going to leave yourselves a lot more vulnerable than you want to be. Competing for capital has come in hard, and it's the first time that we are in that zone where we are going to have more inflows than what we've ever had. So they should not break down this viability, because otherwise the manage in India dream is as valuable as a manufacture in India dream. And that is something that is going to fall down in a big way.
Very helpful,
Abhishek, I just want to add one point.
Please.
While I know that clubs are different from trust fundamentally, but the whole jurisprudence on mutuality, which is again the fundamental predicate, is based on the fact that people come together for a common purpose. There is no profit in that sense. That is what has been the underlying principle from the English jurisprudence also. There is a recent judgment of the Supreme Court, and I'm sure many of you may be aware of, which is Secunderabad Club versus CIT. Citation is neutral citation is 2023 INSC 736. That was a case where the club was investing money into bank deposits, FDRs. And the bank where it was deposited, that bank was also a member of the club. Okay. And they tried to push the mutuality principle, saying that, look, at the end of the day, whatever FDR receipts come, it is basically of the club and therefore individual members. The Supreme Court has not accepted that principle. I don't know whether it has a direct impact, but certainly because it's a recent judgment, I mean, it's probably 3-4 months, it's just fresh from the garden. Maybe it will be useful for the industry to have a look at it and see if there is anything to be worried about from that judgment. Because even in the trust concept, we are talking about the funds being used for, deposit or deposit investment for profit. That's the point.
Yeah, no, fair point. And actually, Amritha, I'm going to come back to you. But before that, just taking this as a segue to go a little bit into income tax, because I know these cases are more in the context of whether the interest income earned by clubs from FDs and so on are taxable or not. Siddarth, I know when this focus is largely on a service tax and GST, but I just want to bring you in for your perspective on the income tax side on the taxation of carry, right? Because I think that's equally important in terms of, we've all said if it is a transaction emanating from sale of securities, then it should be capital gains, but there's a huge effort from the revenue to try and treat it as normal business income. So just want to sort of hear how you're seeing the advocacy on that side progress, because I think they'll have to go hand in hand. You can't have divergent views on one tax versus the other.
Very true. We can't have two limbs under the same house end up actually walking into different directions for that matter. So I think especially with regard to category 1 and category 2 for that matter, it's been well, because we have the pass-through status under section 115 UB, is as though you directly made that particular underlying investment itself. Now, because the government actually did end up actually clarifying that AIF units are actually securities under the Securities Contract Regulation Act of 1956, section 2H, and they have a specific insertion over there. It's obvious that all these particular units do actually end up becoming securities, and the underlying investment is always into securities of these particular companies, because SEBI under the AF regulations mandates that you can end up actually making only investment securities. You can't do loans, any other kind of income, etc. Now, because of this, the industry does actually take comfort in the fact that because this is actually emanating from securities, these are clarified as securities for that particular matter, all of them are dematted as of now, the source of income over there will actually end up becoming capital gains. But that being said, I think if the fund ends up actually having sources of income such as dividend, interest, etc., and we end up applying the same kind of norm on the pass-through basis, then if that some of the money ends up actually going towards carry, because the way the distribution waterfall works in a fund, it's actually first in, first out. First, you repay back all the principal, you pay out the hurdle. There's normally a catch up that applies there, and then you start splitting it 80-20 or whatever fashion you've actually agreed to with investors. If at the point of the 80-20 split, that particular income coming in ends up being dividend or not for that matter, how would that split end up actually getting determined? So that's why I said, even though the Income Tax Act does actually give you pass-through and GST has no concept of a pass-through for that matter, I think it's important for the government to engage with the industry, analyze some of these additional questions, and rather than just creating this sort of non-obstante clause under 115 UB, carve out a separate chapter for the taxation of these sort of common pooled investment vehicles and the like. We actually have far more nuances that have not actually come out as of now. And it will be very unfortunate some of these nuances end up actually bleeding into the GST regime when they end up actually looking at carry for the same. Or worse comes to worse, if CBDT ends up actually looking at the GST regime and then ends up proposing a change for that matter. So these are, like we said, material uncertainties that end up actually existing. It's a relatively young product, just less than 10 years. People carry is actually getting paid out as of now. So this is the most vulnerable time for anyone to end up actually being over there. And whatever they end up actually doing over here, this industry is only going to grow from strength to strength thereafter. But the biggest question is, are they going to go to strength while managing rupee capital in India? Or will they go from strength to strength by actually managing foreign capital overseas? Because Singapore, Mauritius, US, London, all of them for that matter, very simple structures. And India has been extremely welcoming of foreign capital actually coming in. Then it just becomes, we've already seen a number of Indians leave the shores of India very, very unfortunately. We really don't want to start adding fund managers to the yield itself, especially a large number of them want to come back to the country, but they're used to certainty in terms of the taxation regime. Whereas for us, a large amount of it has actually been the industry trying to fill in the gaps, despite actually reaching out to regulators, reaching out to the department and actually asking for clarity. So this sort of exercise needs to be done in earnest. We can't have a piecemeal solution. This sort of patchy work can't end up going. No other country in the world can actually have $100 billion industry that works on patchwork itself. So India needs to end up actually discussing and engaging to end up getting clarity.
Absolutely, Siddarth. And I think the parallel I would draw here is the speed at which the government resolved all the tax issues for InvITs and REITs, right? Which in terms of size is still much smaller than the overall alternate industry if I aggregate GIFT and AIFs together. But I think there the government worked with a lot of clockwork precision and they created a regime which is reasonably clear. Again, everyone doesn't like everything about it, but I think the clarity is very much there, and I think therefore if it needs to do it, there's every attempt that they can make. Amritha, just wanted to bring you in to again sort of get into a little bit of the nuts and bolts. There's this whole debate on what can you pass to LPs, what should be absorbed by GPs. The reality is that whoever bears it, the overall return goes down, right? So it's sort of the economics are today very clear. But any tips you would give? A lot of questions coming on that. Then how should one deal with LP negotiations and contractual documentation around these uncertainties?
I think, Abhishek, I think a lot of funds have already started on the contract piece. As somebody mentioned earlier, a lot of documentation has already evolved on that piece. People have stopped calling it carried interest, called it additional returns. But none of this is going to sort of solve the main substance issue, right? I mean, you'll be changing like language somewhere or the other. It's not going to take away from the substance of the argument. I think what we need is clarity from a legislation point of view, so that people can call it whatever it is, right? One is that. Second thing is from a LP negotiation point of view. I mean, this is an issue that we have to sort of find a way to figure out if it's going to be ultimately borne by the manager entity or it's going to be borne by the LPs themselves. And there I know that a lot of people, I mean, generally, I think speaking to my own peers in the industry and seeing how negotiations gone with other funds, I have a feeling that there is heavy pushback, sure. But I think it's also I mean, this sort of, in this sort of an environment, there's generally a lot of pushback on LPs bearing this sort of additional tax liability. But then there are instances where people are able to, sort of push that negotiation through and somehow sort of pass it on to the LPs in that sense. So that's also happened. It'll be interesting to see how this phase evolves. I think it's totally driven by, like I was saying, a little bit of leverage and a little bit of what your own equation with the LP is, if they're a long-standing LP, if fund performance, etc. But I mean, I think it can swing both ways. It's difficult to say at this point which way it would sort of swing.
No, I've been involved with this particular matter up to the commissioner appeal stage, and one of the arguments which is not there in the High Court matter but was an active argument at the SESTAT level was the revenue neutrality of this, right? So not so much on the carry specifically, but if the trust is deemed to be a service provider to its investors, anyway, all the inputs that the trust is getting, which is really the value of the service, would all be suffering service tax or GST, and therefore, even if it were to provide these services, the trust by itself ought not to have any incidence of claim, which then goes on to an interesting perspective. And of course, it doesn't work if you have international LPs, but if you have, let's say, largely domestic LPs who are institutions, and again, for not a minute am I suggesting that carry should be subject to GST at all. But assuming for a minute if it were, then at least should there be a mechanism for that credit to be passed on all the way up to the institutional LPs at least, so that it's not a real cost in the system. So, and maybe Dipanjan, I'd like to bring you in. So somewhat like the pass-through for income tax, that if, God forbid, this all ends up going negative, should we then at least work to a complete pass-through mechanism so that at least those eligible investors get a credit and the entire GST is not a wash in the system?
Yeah, I mean, as you said, Abhishek, I think this could be the next logical argument, and it at least reduces the burden. But even if you look at it, I don't know, it depends upon who your LPs are. So if it is banks, it depends upon how much of their input and output credit outstanding is. Then, I mean, like in a fund like ours, we have consumer companies, you have different family offices. So most likely, I think it may only benefit or solve one sliver of type of institutions who may be able to offset this against their output taxes, but may not solve the problem at large. And just reacting to what Amritha mentioned and what you said, that look, one is the clarity today, but what happens if after 5 years you say, hey, here are managers who have received carry 7 years back, 8 years back, but then you have distributed the money, you have closed the fund, right? Then on whom does the liability lands is, I think, a very scary place to be in, right? So including if you're receiving carry, you don't even really know that where you should really park it somewhere. or no, I think, and therefore I think I think Siddarth and Ashish both mentioned that we can't postpone this question, right? Because it is, and Amrita, I think you did mention that, some negotiations are happening. At least what we are seeing is that a lot of cases where just, people are just keep leaving it open, right? And when it's left it open, we assume that it is borne by the LPs. LPs assumes it is borne by GP. It's even a worse situation to be in, where it's also a relationship and a reputation loss at some point of time when you actually go and start to argue something opposite to it. So I don't think enough said. I think this is a good ruling to kind of have kickstarted a discussion. I only hope that this just does not get ignored by saying let's keep quiet. Let's use this ruling and say if something comes, we will flash this. Sujit also very adequately mentioned that this is -10 to 10 maybe at best, right? But we are far away from being closer to even 50 or 60 or 70. But if it is not solved, I would say that even if the assumption is that there could be something coming up, people would start to leave India the moment you start earning some amount of carry, to at least remove the uncertainty of what will happen if the carry is called back, right? So I think the criticality of that, and unfortunately, the VC industry in totality may not have made enough to kind of for government to take notice on, and and somebody may say, hey, let the ecosystem first make money, then we'll go after them. Like, so hope that is not something which will play out. And unfortunately, there are two different ministries in play, right? So there's a commerce ministry whose goal to get more capital in, is goal to make AIF successful. But I don't think that's the goal of the finance ministry or the revenue ministry, right? So there are two completely different goals there. So I really hope that we all come together, and maybe hopefully after election this is answer. Otherwise, we are sitting on a ticking time bomb.
No, so Dipanjan, I think on that point,
Situation where it becomes a Spider-Man meme where the LPs and GPs are pointing fingers to themselves and say, "You guys figure out who's going to end up actually bearing that." I think that'll end up
no,
with
but I
like
think
volume.
I think to your point, Dipanjan, on the perception, and this is something I myself heard in the context of the hearings and also in advocacy, that fund managers make a lot of money, right? And funds make a lot of money. I think it's all the success stories that come on the front news and all the headlines. I think, and so that maybe again a feedback for you: get all the failures and all the dollars written off by funds onto the front pages, right? I think let the world see how many cases go south and how many few cases are the bumper success. I know some of you are extremely successful fund managers, so maybe that statistics doesn't apply to you, but in general, Ashish, I want to pull you into something.
Just one point on that. That's actually funny you mentioned that, because when you go and try raising from Indian LPs, they point to it and say, where are the returns from this industry? Everything's on paper, nothing is there. But according to the government, where all of us are making bank,
Yeah.
so you end up so it's stuck between the devil and the deep sea, and you're getting the bird side of both, actually, for that matter.
No, so then
Actually, funnily, Siddarth, the government is not even saying that you're making money. It said, you make money, I'll come then. Maybe I'll wait for you to make money. Till then, I'll keep quiet.
Just two quick points, Ashish. Just quickly changing gears on the IM fees. I think we're not debating the GST levy on that, but one of the cribs we hear from a lot of the investor clients that we have is that they don't get an offset of that technically against their capital gains, right? So similar to the point I was making, that should it be a pass through of the GST all the way up to the investors? Do you think it's also important for the management fee to be allowed to the investors as an offset against their capital gains?
If honestly, purely from a commercial sense, I'm definitely going to say it's only logical. Even when I go back and get down to ground reality and basics of the law, when you're talking about any other asset class, let's take a real estate, you get cost of improvement and other expenses as an added to the cost of the acquisition and the indexation on that. So why would the same parity not apply? Abhishek, at some level, what I want to echo is your statement that you made maybe 20 minutes ago, where you were talking about why is it that the foreign cap investors get away with a lesser tax. Let's dare not say it. You want them to reduce it and make it at par rather than up it for others and make it worse off. So the point is that there has to be a fundamental parity between asset classes. You can't have a certain asset class have the benefit of expenses and something as fundamental as alternative primary investment format, which can't have. So logically, it is absurd not to have it, and legally, there is a clear way out to make it possible. So it is just that this is being signaled out. I don't know why.
Sujit, a quick 1 minute synopsis on just directionally where and when is this GST litigation going to end? Not specific to carry. I think everyone is a little, peeved, afraid, anxious about the aggression of the GST authorities and the extent of GST litigation that's going on. So just your sort of quick perspective on where do you see all of this landing?
You see, I mean, we've had experience of about 5-6 years now. And trust me, the quantum of litigation under GST is multifold more than what one saw during service tax era. And there are all kinds of litigations there. Litigations at a compliance level, litigation at refund level, litigation at substantive level. What you get to see now is just the tip of the iceberg, because, show cause notices are just about getting rolled out. all of which will now culminate into some adjudication orders, and then probably the real game will start. So I am not very, sanguine with the fact that this legislation has brought about simplicity. It has brought in more complexity than anything else, and it's a heaven for lawyers and accountants to make money. I mean, let's face it. But the fact of the matter is, you can't obviously let it go either. You have to fight, because much of your fundamental tax positions are untested, I would say. And therefore, unless you fight it, you will not come to know whether you have actually taken the right call or not. It's very easy to give up and cut a check and give it to the government. So in terms of the way forward, I think we need to dig our heels deep, take the bull by the horn, fight any obnoxious, high-pitched tax litigation that comes about. B, more importantly, please get your documentations in order. Please get your substance of the transaction as recorded as is in the documents, because fundamentally, the esoteric concepts of supply, nobody really knows what a supply is, because supply is defined to include supply. So therefore, substantively, the I would say, the substance over form. Not only that, the form must also reflect the substance. Put it this way. And so therefore, focus on your documentation. Whenever chased by the tax office, I would advise all of you is, come out clean, share everything. You never know what document comes in handy at a later stage. So long and short of all of this is that GST regime is asking for litigation for the very architecture of the legislation and the way it has been implemented. Industry must pull up their socks and actually defend itself and not let go. Because I know many people say that, look, I get credit of that, or it's a pass through, I can recover it from them. How do I need to worry? But if you don't worry and if you don't establish the law, you will be dealing with advanced rulings, tying a noose around your neck. So yeah, that's the point.
No, absolutely. I think you'll need more shelves in your office to get all the GST cases once they get reported. But we have run out of time. I'm just going to request a quick closing comment from Aditi and Rahul. They are the people who actually do all the hard work and create the documents and the form and the substance. And just one more comment, which I often make to all our clients, that this debate of form over substance or substance over form needs to go. Form and substance needs to be the same thing, right? If you approach life from that philosophy, I think it's much easier to deal with issues, because to always give precedence to one over the other is where the challenge starts. So, Aditi, if you want to go first, and then Rahul, just sort of give us your closing thoughts on this topic.
Sure, Abhishek. So, many fine points made in our discussion today, and just to maybe give a bit of my view as well. So, while the approach of the High Court seems to be a first step, there may be some way before the journey is completed on getting a conclusion on this matter. So typically, even while we are ideating pooling structures or fund structures, we do see foreign investors preferring holding of feeder vehicles rather than investing directly into India, because there is some sort of wariness from investors to be subject to reporting or compliance under Indian tax regime. In this context, the hope would be that from the authorities to take a more macro level approach, as the ramification of this issue would have industry-wide implications.
Sure. No.
Yeah.
Thanks. Rahul, would love to hear your thoughts.
Sure. My 2 cents would be, while the one battle concerning the tax on the fund under the service tax has been won, but the question of GST applicability still remains to be the gray area, as rightly mentioned by the speakers. The contention that the funds serve as a pass-through, which has been taken in the Karnataka High Court order, that in my view should sail through under GST also, but provided that the scheme documentation clearly reflects the pass-through nature of the activities that the fund carries for the contributors. Moreover, we need to wait for the outcome to see how the tax authorities have taken the stance on the classification of carried interest as to whether it's a ROI or it's an additional fee for service. That we have to wait and watch on the outcome. Yeah.
Perfect. No, thank you, Amritha, Ashish, Dipanjan, Siddarth, Sujit. Thanks for being part of the trailer. The abhi to picture baki hai, so we'll get you back as we shoot this some more. Thank you everyone for participating. And I hope this has been useful. We're going to put up a recording as well. And thank you once again for your time.
Thanks, Abhishek.
Thank you for inviting me.
Thanks, everyone.
Thank you. Bye-bye.
Thank you.
Thank you.